Welcome back to the Global Ledger. I'm Justin. Over the last few years, few topics have generated as much confusion or as much emotional reaction as central bank digital currencies, better known as CBDCs. Depending on who you ask, a CBDC is the future of money, the end of cash, or a tool of surveillance, or a necessary modernization of the monetary system. But almost all of those debates skip the most important question. Before asking whether CBDCs are good or bad, we need to ask something much more basic. What exactly is a CBDC supposed to be? Is it a new form of money, a new liability of the central bank, or simply a new payments technology layered on top of the existing system? That distinction matters because it determines whether CBDCs would reshape finance or simply repackage what already exists. Let's get into it. Let's start with the first principles. Money is not defined by its form, its speed, or its technology. Money is defined by who issues it, who accepts it, and what balance sheet it sits on. Cash is money because it's a liability of the central bank. It's accepted at par and final for settlement. Bank deposits are money-like because they are promises to deliver central bank money, cleared through the banking system, and supported by regulation, insurance, and liquidity backstops. Now notice something important. We already live in a largely digital monetary system. Most dollars today never appear as cash, never touch a blockchain, and never leave balance sheets. So when someone says CBDCs are digital money, the correct response is money has been digital for decades. The real question is who gets access to what and under what conditions. So what is a CBDC? What is it really? At its core, a CBDC is simply a direct claim on the central bank represented digitally. That's it. But that single sentence hides several radically different designs. Okay, a CBDC could be wholesale, meaning used only by banks and financial institutions. It could be retail, okay, available to households and firms. 3, it could be account-based, like a bank account at the central bank. Or it could be token-based, like a digital bearer instrument. Each of those choices leads to a completely different system. And most public debates lump them all together, which is why the conversation, I don't think, goes anywhere. Let's look at CBDCs as money for a second. If a CBDC is designed as money, it means households hold direct central bank liabilities. It means commercial banks lose deposit funding. And it means that the structure of the banking system changes fundamentally. This is where the fear comes from. If everyone can hold risk-free central bank money directly, why hold bank deposits? Why tolerate bank risk? Why accept lower yields? In a stress event, funds could flow instantly, digitally, and at a massive scale from banks into CBDCs. That would not stabilize the system. It would accelerate runs, really, which is why most central banks are extremely cautious about retail CBDCs as new money. So let's look at CBDCs as a payment technology. Okay, now contrast this with a very different interpretation. What if a CBDC is not new money at all, but it's simply a new settlement rail? In this version, CBDCs do not replace bank deposits. They do not eliminate intermediation, and they do not sit in competition with banks. Instead, they improve settlement speed, reduce operational risk, enhance cross-border payments, and modernize clearing infrastructure. In other words, CBDCs become plumbing, not currency. This is where most real-world CBDC projects are heading. quietly, and I think deliberately, not toward replacing banks or replacing money, but toward replacing slow, fragmented settlement systems. That's my opinion. If CBDCs were obviously superior money, they'd already exist. Okay, the reason they don't isn't technological, it's structural. Central banks understand something markets often forget. Okay, that is, money is not just about efficiency, it's about stability under stress. Any design that weakens bank funding, undermines intermediation, or concentrates risk creates more problems than it solves. So, what looks like hesitation is actually institutional discipline. CBDCs are being tested in wholesale settlement, collateral mobility, cross-border clearing, not as a retail revolution. Here's the part, though, that often gets missed. Even if CBDCs never become dominant retail money, they still change the system. Why? Because once central banks modernize settlement, private actors will build on top of it. Alternative payment forms will grow, and new money-like instruments will emerge. Which brings us to the uncomfortable reality. The real innovation is not coming from central banks. It's coming from the shadow system around them. And that leads us directly into the next episode. In episode 86, we're going to talk about stablecoins. Not as crypto hype, not as ideological rebellion, but as what they actually are. Okay, privately issued money-like liabilities backed by collateral, operating outside traditional banking, yet deeply entangled with it. So if CBDCs represent cautious institutional evolution, stablecoins represent fast-moving financial experimentation, in my opinion. And the tension between the two is one of the most important stories today in modern finance. That's next. Thank you for listening to episode 85 of The Global Ledger. I'm Justin, and thank you for being here.